If you've ever looked at your bank account and thought, there's no way I can invest or save with this amount, stop scrolling, because this is the only financial channel that actually disagrees with you. Welcome back, or welcome if you're new, to Financial Blueprint Diaries. This channel exists for one reason: to decode the complex world of budgeting, investing, and personal finance in a simple, bite-sized blueprints that actually fit your weekly paycheck. Whether you're a college student surviving on financial aid, or you're working hard but feel like you're getting nowhere, this is your space. We don't judge your spending, we just optimize it. We turn scarcity into strategy weekly. Today, we are diving into one of the biggest debates in investing: dividend stocks versus growth stocks. What should students choose? And by the end of this video, you're going to have a clear action plan. If that sounds like the kind of finance you actually want to learn, hit that subscribe button. It's completely free to build your future with me weekly. Let's build this blueprint together. So here's the question that stops every student investor in their tracks. Should you buy stocks that pay you cash right now, or should you buy stocks that can make you rich later? Here's the thing: both of these strategies have made people wealthy, but they work in completely different ways. And if you pick the wrong one for your situation, you could be leaving serious money on the table, or worse, losing sleep over market swings you weren't prepared for. Let me break this down so simply that by the end of this video, you'll know exactly which path is right for you, and more importantly, why. Let's start with dividend stocks. Think of dividend stocks like a salary for your money. When you buy shares in a dividend-paying company, that company sends you a cash payment usually every 3 months just for owning their stock. These are mature, established businesses with steady revenue streams. Think companies like Coca-Cola, Johnson & Johnson, or utility companies that provide electricity and water. They're not trying to grow at 100 miles an hour. They're already huge. Instead of reinvesting every dollar back into the business, they share their profits with you, the shareholder. Here's what makes dividend stocks attractive for students. Number 1, regular income. You get cash in your pocket, regardless of what the stock market is doing. That means even if the stock price drops, you're still getting paid. Number 2, lower volatility. Dividend companies tend to be more stable and less risky than flashy growth stocks. They've been around for decades and have proven business models. Number 3, downside protection. When a market crashes, dividend payments can help cushion the blow. Number 4, compounding power. If you reinvest your dividends to buy more shares, your money starts growing exponentially over time. But here's the catch: dividend stocks typically offer slower growth than growth stocks. You're trading explosive potential for steady, predictable income. Also, dividends are never guaranteed. If a company hits hard times, they can reduce or even eliminate their dividend payments. Now let's flip the coin. What are growth stocks? Growth stocks are companies that are expanding fast. Think tech companies, innovative startups, or businesses disrupting entire industries. These companies typically pay little to no dividends. Why? Because they're reinvesting every dollar they make back into the business to fuel even more growth. Instead of getting cash payments, your return comes from the stock price going up, sometimes dramatically. Here's why students get excited about growth stocks. Number 1, higher return potential. If you pick the right growth stock, your investment could 10x, 50x, or even 100x over time. Number 2, compounding through appreciation. As the company grows, the stock price grows with it. Over decades, this can create massive wealth. Number 3, you're investing in the future. Many of today's biggest companies, Amazon, Google, Tesla, were once growth stocks that paid no dividends. And this is a big but, growth stocks are much more volatile. When a market drops, growth stocks often drop harder and faster. There's no dividend income to cushion the fall. You're riding the roller coaster up and down. Let's put these two side by side so you can see the difference clearly. Dividend stocks give you regular cash payments, lower risk, stable mature companies, and steady but slower growth. Growth stocks give you little or no dividends, higher risk, higher volatility, fast-growing innovative companies, and explosive potential with bigger swings. In short, dividend stocks are about income now. Growth stocks are about wealth later. The data tells an interesting story. Over the last 50 years, companies in the S&P 500 that pay dividends have delivered an average annual total return of about 9.2%. But growth stocks have had periods of massive outperformance too. In 2026 alone, we've seen some fascinating shifts. The typical dividend-oriented strategy actually outperformed the S&P 500 in the first half of 2026 after trailing it in 8 of the previous 10 years. The Russell 1000 Value Index jumped 15.9%, while the Russell 1000 Growth Index gained just 5.3%. What does this tell us? Different strategies win in different market conditions. That's why understanding your personal situation matters so much. So here's the million-dollar question. As a student, which one should you choose? Here's the truth that most finance gurus won't tell you. You don't have to pick just one. Most successful investors build portfolios that blend both dividend and growth stocks. Here's the framework I want you to remember. If you're a student with decades ahead of you, you have the ultimate advantage, time. You can afford to take more risk because you have years, even decades for your investments to recover from market downturns. That means growth stocks should probably make up the larger portion of your portfolio. Think about it. If you're 20 years old and invest $1,000 in a growth stock that averages 12% returns, that could grow to over $30,000 by the time you're 50. That's the power of compound growth over decades. But, and this is crucial, you should still have some dividend stocks in your portfolio. Why? Because 1. They provide stability when growth stocks crash. 2. Reinvested dividends create their own compounding effect. 3. They teach you the discipline of passive income money that comes to you without you having to work for it. And let's be real, as a student, getting a small dividend check every quarter feels amazing. It's proof that your money is actually working for you. All right, let's turn this into a real blueprint you can actually use. Step 1. Start small. You don't need thousands of dollars. Many brokers now let you buy fractional shares with as little as $5 or $10. Step 2. Build your foundation with index funds first. Before picking individual stocks, consider ETFs that give you diversified exposure. An S&P 500 index fund gives you both growth and some dividend exposure automatically. Step 3. For your growth allocation, look at ETFs like QQQ or VUG that track growth companies. For your dividend allocation, look at VIG or SCHD that focus on dividend-paying companies. Step 4. Reinvest your dividends. Set up automatic dividend reinvestment. This is called a DRIP. It's like compound interest on steroids. Step 5. Be consistent. Invest a fixed amount every month, even if it's just $50. Consistency beats timing every single time. And most importantly, don't panic. The market will go down. Growth stocks will crash sometimes. But if you have decades ahead of you, those crashes are just sales opportunities to buy more at a discount. So here's what I want you to remember from today's blueprint. 1. Dividend stocks give you income and stability. Growth stocks give you explosive potential. Both have a place in your portfolio. 2. As a student, your biggest advantage is time. Lean more toward growth, but don't ignore dividends completely. 3. Start small, stay consistent, reinvest your dividends, and let compound growth do the heavy lifting. If this video helped you understand the difference between dividend and growth stocks, drop a comment below telling me, which strategy are you leaning toward? And if you want more weekly blueprints on investing, budgeting, and building real wealth, hit that subscribe button and turn on notifications. Remember, your financial future isn't built in a day. It's built in the small decisions you make week after week. This is Financial Blueprint Diaries, and I'll see you in the next one. Until then, keep building.